Good morning. Welcome. It is Fed week. It is another day with the markets opening to the upside. But as always, as I watched last week, especially, I'll caution you to, or that it is very much similar to Lucy with the football, and we are Charlie Brown. So with that, it is Monday, March 16th. This is Breakfast Club. I'm John Hutchinson. This episode is brought to you by Guinness, since tomorrow is St. Patrick's Day. Enjoy all of those news programs where everybody says top of the morning to you ad infinitum across the U.S., as they always do. We have a number of quick things to walk through today. And there we go, making sure that everything's keeping up here. Good. Okay. Again, futures actually even higher than I had originally posted here in my slide deck. NASDAQ opening 1% higher. It is every sector is green as I look at futures. The Asian markets were up overnight. European markets up. Oil retreating back below 100 this morning, and that is helping stocks, especially on the tech stock side. There are still some headwinds. That last week, especially Thursday, really was a culmination of three things happening at once, which resulted in the markets falling harder on Thursday, a little bit of a rebound on Friday. But overall, we're still in slinky mode where markets are trending lower, but we're not in, I still call it a rolling correction. It's not a huge sell-off or massive sell-off. There's no capitulation point, at least at the moment. We're still in we're now in week 3 of the Iran conflict. And again, still at this juncture, the only thing that matters is the price of oil. But last week was really dominated by what I call the fizzle. And it's why I mentioned Lucy with the football, because we had a number of days last week, throughout the week, where markets would open higher and then sell off through the remainder of the day, as in most cases, the price of oil would rise through the day up until oil markets close. So it bears watching. Just because the markets rebound strong at the open doesn't guarantee that those will hold. Maybe they will today, and it's one reason why I remain cautious in averaging down in the AI2 side. Just because we get a one-day rally doesn't mean we're out of the woods. So last Monday was really an important day in that it showed us that as oil pulls back, the markets will rebound. Our AI2 portfolio alone swung 8% on a single day, from a 3% loss to a 5% gain. But as the price of oil rose through the week, and as those fizzle events happened on a daily basis, we were only able to hold a 2% gain, or just under a 2% gain, by the end of the week last week. We're opening today up a little over 2.5%. So it's like a repeat of last Monday. But what's different here is the price of oil is $10 higher today than it was last Monday. So we'll keep our eye on the price of oil, continuing to, as it continues to probably oscillate between 95 and 100 right now. I don't believe there was any major news or any major event over the weekend that will, suddenly spike it, but we'll see. So this is what the fizzle kind of looked like. Each day we had opens. Most of that was on the back of economic data, with the exception of the GDP revision. The economic data was either in line with expectations or slightly ahead of expectations, and that was a positive to the markets on the back of the negative jobs report from the week prior. But what we're seeing right now is we've moved from the short scenario for the Iran conflict into the moderate scenario, meaning a conflict that lasts anywhere from 2, 3 to 6, 7 weeks, The commentary over the weekend was, we may be a few weeks away. So, the sooner that ends and things at least return to normal in the Strait of Hormuz and oil starts moving, the faster markets will recover. But it's the reason I did not average down last week for my AI2 folks is I didn't trust a one-day rebound. And I said I'd wanted to see multiple up days, and that's multiple up days at the close, not at the open. And what we had were multiple up days at the open, but not at the close. So we finished the week positively, but we still have headwinds, and those headwinds are growing right now. Although all three here listed, oil, the US dollar, and the 10-year yield, are all moving in a more positive direction today. Oil is down. Looked a little bit ago, it was down 3%. The 10-year yield was falling, and the dollar was falling, pulling back from the 100 level. The 100 level is a critical psychological level for the US dollar. Excuse me, especially as it relates to trade. But the rapid rise in 10-year yields from below 4% to above 4.3% was a signal from the bond market that the risk of stagflation was rising. Stagflation is low or slow or no growth with still rising prices. And we had elements of stagflation. Again, it's many of these economic terms, stagflation, recession, things of that nature, you might think we're in such a scenario, but until it's actually happening and has been happening, it is difficult to say this is where we are. It's not like a map at the mall where there's a little, it's the little red triangle with a dot, and it's you are here. Are there recessionary conditions? Yes. Are we in a recession? Technically, no. Are there stagflationary issues? Yes. Are we in a stagflationary environment? Unknown, not known. Inflation rising slowly has specific causes. Tariffs are number one. Price of oil now number two. So, but at the same time, there are also some prices that have receded, which makes the inflation argument more complex, or even too complex, to be blunt. So these three categories, oil, yield, 10-year yield, and US dollar, are the ones that I'm watching this week. If they continue to pull back from recent highs, we have the setup for in a broader and more extended rally in the stock market. If we have mixed results, you might see a flatter market. Certainly, markets they may be up today, maybe up a little bit tomorrow, but I think you'll see markets still be a little bit slower heading into the Fed meeting this week. The Fed not expected to do anything. No rate cut on the table. Certainly not. I don't see rate hike or rate cut to be on the table. The most important thing that the market will be looking for is whether or not the Federal Reserve is still projecting one or two rate cuts for 2026. If the Fed holds the line on that expectation, even if they push it out further in the calendar year, markets should react positively to that. If there's any change in that plot, and that change would really be revising forward expectations down to zero cuts, then I think you have a significantly negative market event, which is not priced into the market right now. So let's hope that the Fed stays on the path of two cuts, even though the market right now has pushed out rate cuts to September or October at the earliest, given current conditions. And those rate cuts will also be largely dependent on two things: when the Iran conflict ends and when the price of oil stabilizes. Powell's language will also be important. certainly the impact of tariffs as we ended and began the new year, cost and impact of energy, how that's affecting the inflationary outlook. But underneath all of that, too, is what Powell says as it relates to the labor market. The Fed maintains a fairly broad range of statistics that they don't necessarily share with us, but it's it has been the Fed's case since December that inflation and labor are the competing forces for when and how much the Fed would cut interest rates. So as we sit right now, that remains uh, the challenge for the inflationary rock and the labor hard place, so to speak. So the forward language or the forward-looking statement from the Fed will be a key factor, and the market will be trying to unwind from that what the Federal Reserve is zeroing in on as its most important or most influential factor in when and whether it will cut rates. The other big news for this week, and I got to tell you, I think someone somewhere knows something, because against this backdrop of fizzles last week, one of the stocks in our portfolio keeps rising, and that's Micron. Um, and Micron reports earnings this week, Wednesday, after the market close. And it's always tough to wait for a company that you're holding with, especially when it has a strong gain, to report earnings. And the reaction by Wall Street to earnings in the last several weeks has been difficult to gauge and uneven. So what I would really like to see is Micron not have a big gap either way, but just a steady rise higher, especially if they outperform the expected values. EPS at 866, revenue at 19 plus billion, margins remaining high. These would be the key factors Wall Street will be looking for. The other point from Micron coming out of or it will be divulged, I expect, in their earnings call, is a minor shift, maybe a major shift, to kind of like the futures market, where they're now taking orders that extend more than 1 year for their high bandwidth memory contracts. So instead of basically telling NVIDIA, for example, well, you can buy this year's memory, it's saying you can buy this year, next year, and the year after. And what that provides is greater visibility to Wall Street in the continuity of memory chip sales. And one of the challenging factors I have in analyzing, assessing, projecting price for Micron is the analyst coverage isn't as extensive as it typically is with most other companies. And let me give you a breakaway to a different screen here and show you what I mean. Take a look this is in FinViz. You can see here in 2026, right? They are in Q2, so we're here, right? There are 40 analysts with full year estimates. Next year, there are 37. For 2028, however, there are only 16 analysts providing coverage. And what's difficult here is if you look at these 2 years, 27 and 28, there's a near 10% decline, a greater than 10% decline in expected earnings for 2028. So that this is right. This is not uncommon in the semiconductor or memory markets, because they tend to be cyclical. So this would be consistent with analysts saying the cycle started here in 25 and it's going to end, and then a new cycle will start sometime in 2028 and extend. Right. So this number for 2028 right now, however, is it's a headwind on my price projections because it's lower than the prior year. And then you look at what one analyst is projecting for 2029, and it's a significant expansion in earnings from both 2027 and 2028, and near doubling of earnings from the current fiscal year, from 2026 through to 2029. So this is what I mean. Sometimes the volume of analyst coverage can make it difficult to forward project what the expectations are. Micron has been addressing the main issue is capacity to meet demand, and they are rapidly addressing that. And that will be another key factor in their earnings call. If they show a path forward for expanded production, again, being the number two HBM high bandwidth memory supplier behind SK Hynix, they can maintain and or grab additional market share. I think you're looking at still think you're looking right now at a stock that has the potential to double into the future, not this year, not in 1 year, but certainly over the next several years. The entirety of the semiconductor and memory and storage complex is filled with companies with significant growth potential over the next 3 years. Does Micron beat on earnings, beat on revenue, and raise forward guidance for 2026, 2027? Their memory is already sold out for this year, so the forward visibility will be into what are sales commitments for 2027. And don't be surprised if, against the backdrop of the overall market, if you still see a pullback in price on Micron. Recent projections from the banks and Wall Street analysts are pushing Micron up into the $500 to $700 per share range. Great. We've been in it since 220, so please keep pushing that number as high as you want. I'm happy with that. But this is an add-on to Broadcom's coverage a week ago. And what is the future? What does the future hold for earnings? So those are the two major events that I see right now. Economic news is relatively quiet this week because all eyes will be on the Fed. They already have their PCE report from last week, which was slightly higher than anticipated. But at the same time, we had CPI last week, which was essentially in line. So again, competing metrics for the Fed to decipher. So I think we'll stay on the Fed will remain the key driver for the week. Oil will remain the key metric. Oil up, market down, oil down, market up. And Micron is the only stock right now that I see having potential for moving elements of the chip market. So we'll watch Wednesday, 2 p.m. The statement, dot plot, et cetera. What does the Fed forecast? And then Wednesday's going to be a busy day with Micron earnings right after the close. So a little bit of a simpler focus this week. And I think that will close us out. We do have the AI2 briefing today at 4 p.m. And for those of you attending Investors Blueprint Live, we have your preview session on the AI2 index set for tomorrow at 4 p.m. Eastern Time. And then we have the IBL conference taking place this Friday and Saturday. So last day to get tickets will be today. But for those of you attending in Dallas, will update the agenda and expectations for you tomorrow during the preview session, and then we'll be ready to go. I've already built my presentations. I'm really excited about some of the things that I'm able to share at this conference. So for those of you attending, I look forward to having you there. And for Joe, top of the rest of the day to you, and yes, we'll see you. I think you're coming virtually, so we should have another email out. If not, there was one that went out yesterday. And I think we'll close the tickets probably around midnight tonight, and then be ready to go starting tomorrow with the preview session. So keep it short today. Markets up, still up. Futures right now pushing 1.1% on the NASDAQ, almost 1% on the S&P. So as I said, an update, oil down 3%. That's helping. And we'll see how it goes. Let's hope we can hold the gains today. That's what I would really like to see. With that, enjoy your St. Patrick's Day tomorrow. And for those of you attending the conference in Dallas, we will see you on Friday. I will be back next Monday at 9 a.m. with Breakfast Club. So we'll see you next Monday, March 23rd at the usual time. Thanks very much for joining me. Have a great day. And it's a good day to be in the markets, at least at the open.